We're going to talk a minute about mortgage lending and DSCR lending, something that's really important out in the marketplace, obviously. So if you find the video helpful, take a minute and like it. Don't forget to subscribe to our YouTube channel and make any comments below, and we'll do our best to get back to you on those as well. So I'm here today, guys, with Ross Wright with Nexa Mortgage. They're headquartered here in Dallas. And Ross, what's that tagline you guys have got?
Nobody beats my rates.com.
That's a great little way to find things. That's what everybody's looking for. And here with his right-hand man today, too, Armando. Welcome, guys.
Thank you. Great to be here.
You know, what I want to take a minute and talk about today is, first off, you know, what is so hot in the industry, which is this DSCR lending. So for all the rookies out there, what is DSCR?
It's a debt services loan, and basically what it does is allows investors to be able to purchase homes with low documentation.
Now, is that almost obvious? Is that purchase or refinance?
Both, either or.
They have a purchase program for
Absolutely.
DSCR?
A purchase program, cash out. So if they want to pull cash out of their investment properties. And, you know, if you're an investor, you've got tax returns, and if your CPA is working their magic, they're getting you as close to zero, or even maybe even carrying over a loss in your taxes. And that's great when it comes time for taxes, but when it comes time to borrow money, it becomes problematic.
Oh, yeah.
And so what we then do is we have investors that have what we call make sense loans, right? And so what Armando is going to do is he's going to look at the appraisal that comes back. And on the appraisal, the appraiser gives an estimated value of the property, but they also give an estimated rental. And they do a rental analysis and say, hey, the house should rent for $3,600 a month. And as long as our principal, interest, taxes, and insurance is below that $3,600, right, then it's basically a no-doc loan. You
don't hear that word no-doc too much anymore, do you? So
kind of reminiscent of times past, right?
I'm going to cut into some things here about DSCR lending, let you guys comment on these things along the way. So I want to talk about acquisition and refi in a moment, but let's talk about what you just said. So first off, traditional mortgage lending, you need to get an appraisal. We understand that. And that appraiser is also, you want to get a rental value. And can the borrower provide you comps as well and evidence of that?
Sure, they can give that, right? But at the end of the day, it's the appraiser who's an arm's length away, who's going to be giving that determination of value. If we feel that that's low, then we can say, hey, here's some comps, and then they can reconsider that value.
Awesome.
Yeah.
So they can help do some things, because the appraisers are not always dead on point, and I get that. Nor the investor side of the equation. I understand that too. Everybody wants to push the numbers. And you want reasonable, legitimate, value out there. I get that. So you made the word no doc. Okay, so you're talking to these newbie investors out there about a loan. When you say no doc DSCR lending, is this? Do they need to fill out an application?
Yeah. So the application would be what they fill out when they're going to be filling out their income, assets. We don't even consider that, because it's more asset driven, right? So what they're looking at,
but they still need the application.
Absolutely. You fill out the loan application. It's a very light application. But as far as like tax returns and having to show schedules and this and that, it's non-existent. None.
Really? So it's an application only. So what I'm hearing, just heard, is asset-based type loan, pretty much?
Pretty much.
Based on income that it can produce as well?
Right.
So what's the value of the asset? What's the income it can produce, right?
Right.
Okay, so, wow, I like that. That's almost akin to a sense of a hard money loan.
Yes.
Except hard money lending usually deals with construction in advance. And I'm assuming that DSCR lenders don't want to deal with construction.
We have it at a construction
option. Well, we finance them out of the construction loan.
Yeah. So they go to the asset-based hard money lender to get the acquisition rehab type loan.
Right.
It gets completed, then they turn around, come to you guys for that
refinance
and cash them out. But limited documentation. That's amazing. Then it's asset-based. So I got to ask the next question. Is it personal liability too or not?
Yeah, and they're going to look at your credit score, obviously. And, we've got different sources. Well, we've got over 260 different investors that we work with.
Just 260?
Yeah. So we're the nation's largest brokerage. And we are the nation's largest lender network as well. So I don't want to tell my real estate agents or anybody who's counting on me to get financing for the clients that they've worked hard to get.
Right.
I don't want to tell them that, and I don't want to kick the can down the road. So what I'll do is reach out to my investors and say, here's the situation. And then Armando comes it over and says, here's what we can do. And so now I'm going back to you and I'm saying, hey, we got a path for your client to be able to purchase.
Awesome. I love that.
Or refinance.
But asset-based, limited documentation. Okay. By the way, I have no trouble with personal liability. I find it funny in the residential world. If you do a $50,000 loan, $100,000 loan, you're taking personal liability on it. You go into the commercial world, you get a $5 million loan, no liability.
Right.
I one day I will understand that. No, I won't.
Right.
I'll never understand that. I don't get it. I know they put 20% down normally, but heck, the investors do the same thing too sometimes, and they still take personal liability.
Right.
Whatever. It is what it is. So limited, limited doc. No, you have to own the property. Tell me about let's talk about a refinance. What I see so much in the marketplace, guys, is it's what Armando just said. We take them out of that construction loan. Whether they go to a small bank to borrow money and get the rehab that bank loan, it could be a longer term loan, but it's going to be more of a 15-year type loan. You guys are going to offer a 30-year loan basically, which is a great benefit to the investor marketplace. But if they are in an existing mortgage and they need to do this refinance for whatever reason they want to do long-term lending, Airbnb, whatever they're going to do out there. What's the loan to value they're going to be looking at? How does that work within the DSCR world? In the hard money lending world is typically 70% max of the after repaired value. What do you all look at on a DSCR basis?
So we have investors that will go up to 85% on a DSCR. Armando,
there's investors out there that go to 85.
Right. Yeah. 80 is the normal. Once you go to 85, you're going to pay that because risk equals rate. Right. So the higher you go on the loan to value, the higher the interest rate is going to be. The terms are going to change. Right. So 80% is what we found is a really sweet spot to where the door really opens up wide to the different investors, different situations, different pricing, different credit score requirements. And then the debt services ratio as well. And Armando, can you go over like the 1%, the 1.25 so that investors can understand?
Right. So the LTV is usually predicated on is the debt service. Does the rent cover the payment? You're ideally looking for a 1-to-1 coverage on it. There are options to go negative.
Let me stop you real quick for us math idiots in the world. 1-to-1, 1.2. So let's say, for instance, you have a $100,000 mortgage or loan to value, not loan to value, after repaired value home. The appraised value is $100,000. The investor is going to borrow $80,000. So with that $80,000 loan, there's going to be an interest rate associated with it for principal and interest over a 30-year term, and there's taxes and insurance. So let's say that number, principal, interest, tax, and insurance, equals $1,000, whatever that number might be. Okay. Let's take it down. Let's say it's $800 all in. And by the way, here in Texas, taxes are higher. That throws things off a little bit. In so many other states, it's not, and I get that too. So you've got this $80,000 loan, PITI, the payment is $800 a month. The value is $100,000. So a 1-to-1 ratio would mean what?
So it's referring to the payment, the rent comp analysis, the rent estimate covering PITI.
Okay, so if it's 1-to-1, rent's $800 a month.
That means
PITI is $800.
That means exactly. It's covering it 1-to-1.
Okay. So what do they look at normally?
That's what what you want to have is a 1-to-1 coverage on that. So there's pricing implications if you go, let's say that it's a 1.15, then you get better pricing because obviously that rent comp is exceeding.
Okay. What I hear so much of, especially in the banking world, is a 1.2 debt to income ratio. What does that mean, for instance? So if I have an $800 a month payment, what's a 1.2 debt income coverage
So
look like?
that's different things. We're not talking about debt to income. We're talking about DSCR.
He was talking about
debt
services.
The
debt service
yeah.
ratio, excuse me.
So the debt service. So that means that the rent is surpassing the payment, PITI.
Yeah, by
And so
20%?
that's yeah.
So if 20% of $800,
$1,200
is going to be 160,
Right.
you want rent to be 960 versus 800.
Right.
Okay. I got it.
So there's options for you. There's actually negative rent comp options too that require more LTV. You can still do it, but you have to have more down payment.
So, or just a lower loan to value, period, whether that
Right.
be. So if you bought a house at a really great price or into it at the right price, or you've owned it for a while and paid everything down, that loan to value can adjust it. So
Right.
I heard sweet spot 80%, max 85%, but you start pushing those numbers, interest rates go up, requirements go up,
Right.
other issues are out there. Let's talk about going down. Let's talk about a 75% loan to value. Let's talk about a 70%. So many people who are watching this video, they might be getting a loan from a hard money asset-based lender for that construction rehab of the project. And for instance, we have an asset-based lending company out there, and our max loan to value is 70%. So if all they want to do is what is called a rate and term refinance, meaning not pull any cash out, maybe their closing cost, that's it. But that loan to value is 70%. How is the market from y'all's end going to look at that deal?
Well, actually, it's more favorable. You're going to get better pricing, better cost in regards to your rate, better rate because it's a lower risk loan.
So your interest rate will go down a little bit,
right?
And again, it doesn't matter about. I know they're going to look at credit, but they don't really. They look at credit, but they don't really look at credit.
Mm-hmm.
Is that talking about?
Use a credit score as a threshold.
Is it when they look at credit? Is that a factoring of? Does that factor into the rate they get also?
Absolutely. They're really just looking at the credit score, so they're not looking at all the other parameters of the credit, but they look at the credit score. Now we're saying, okay, I've got a 780 borrower who's doing 80% LTV, loan to value. They're only putting 20% down, as opposed to a 680 credit score who's wanting to do that same 80%. The rate is going to be much higher. So, risk equals rate. So as you say, hey, I'm going to put more money down, my investor is like, okay, great, my risk level is going down, right? So it just sweeps the deal all the way around.
And for investors out there, again, it's still an asset-based loan, but credit score is important, which I understand because, again, that is indicative of how you do things and how you pay bills, which I understand, which is why the lenders are doing that, and I understand that. But I find it funny sometimes, like in the hard money lending world, guys, we see credit scores that come in that we call barely breathing. It's like, how can it go that low?
Right.
And from my end, when I'm making a hard money loan, I'm really looking at the property first and foremost. Sure. I'm looking at the client's ability to handle that transaction properly, the repairs, the marketing, the sale, and can they make the payments as they're going through all that. Is there a minimum threshold in the DSCR lending world?
As far as
the credit score?
Yeah, so I've got some investors that are going at a 580.
Okay.
Right.
It's still kind of low in the credit world.
It is. And of course, the terms are going to reflect that. Risk equals rate.
So if you've got, I'm just going to throw a number out there for this, and we'll talk about rates here in a minute, but you've got a 7% interest rate for a 75% loan to value for someone who's got a 640 credit score. That guy that has that 580 credit score, the lender might come back and go, I won't do 75, but I will do 70.
Exactly.
I get that. Yeah. And instead of getting a 7% rate, you're going to get a 7.5% rate maybe.
Right.
do they kind of give you options like that once in a while?
Yeah, absolutely. Your theory is right. It probably be a lot higher than the 7.5%, but the point is yeah, we'll look at it and give you options. That's the key.
So we're talking 8.5,
yeah,
9.
I would say that. I would say the difference between the two credit scores.
So that credit score is really going to be.
It definitely is because that's really the only thing that they're using to assess risk from the client, right? Because pretty much everything else is what's the debt services ratio, what is the loan to value. So what they're doing is they're saying, okay, well, I've got an 800 credit score buyer. Wow, right? And low risk, we're feeling great about that. When you start getting into 600s, low 600, 580, right? Now they're really wanting to see that, if it's costing $1,000 in PITI, they're wanting to see like that 1.5% that Armando was talking about. So they want to see that the rent is higher, substantially higher, because it balances out the risk.
Okay, so I get the balancing act.
Mm-hmm.
I get lower credit score, higher rate. That's common sense in my mind. I get it. Maybe lower loan to value, but you can still get the loan.
Right.
But then they're also going to want, and that lower loan to value makes it easier to get the higher, debt service coverage out there also. Because the average rental amount won't change.
Right.
But if that loan to value is going down, that gives you a higher, debt service coverage. That it may have been 1.2 at 75, it might be 1.25 now at the 70% loan to value range.
Right.
What about lower loan to values? What about a 50% loan to value?
Yeah, it's the opposite, right? I mean, risk equals rate.
Again.
Right. Risk equals rate.
I'm going to have to ask a common sense question real quick. I know I butted in there. There has to be a floor.
On where it doesn't.
Yeah.
At
some point,
there is a floor rate. I mean, I would say floor rates are maybe in the 6s.
I think what he's saying is there a floor? In other words, if I said, hey, I got this guy who wants to do an 80% LTV, what's the rate? And then you're giving me that rate, and I'm saying, okay, well, actually, he wants to put 50% down, so now we're only doing a 50% LTV. And you're like, oh, okay, well, now the rate is going to be less because the risk is lower, right? I think what Scott is asking is,
going down.
Is there a threshold of where it doesn't really get any better?
Oh, LTV wise, yeah, and I would say about 55 or 60% LTV is going to.
So at some
getting
point
below that, the pricing's the same.
Yeah, I got it. Okay.
Yeah.
Again, I look at that and I listen to that and I go, that is common sense. At some point, they can't just lend the money that cheaper.
Right.
That would be nirvana if we could get there, but we ain't going to get there. I go back to the very inception, guys. We were talking about an acquisition DSCR loan that I have not actually heard of. I've always been in the mindset that it has been a type of a loan that an investor, let's say, gets on a property. So we're talking about investor loans. We're not talking consumer, right?
Right. No residential.
No residential.
We're talking about
consumer.
Sorry, primary is what I meant. It is residential.
Yep.
Right.
It's non-owner.
It's not primary.
Yeah, non-owner occupied.
Non-owner occupied. Investment property.
Yep. So this is for investors, non-owner occ loans, and you're saying that there is a product out there where they can use a DSCR loan to buy the home. Now that's not going to be a construction loan. It's going to be the home's got to be in good condition, good shape, et cetera, based upon what that appraisal is. That's available out there.
Yeah. It's solid. 20% down. It gets very favorable terms.
Now is that 20% of cost?
Purchase price.
Okay, so if you're doing an acquisition, it's 20% of cost, not of value.
Correct.
Okay. What about a refinance? They're going to go off the appraised value at that point, right?
Correct.
Right.
So a little bit different way to approach that. And by the way, that's reasonable.
Yeah.
In fact, in today's banking world, you go out to a small commercial bank, you're putting 20 to 25% down no matter where you're going today.
Right.
So I look at that and go, same thing, only different. Are the rates different on a purchase versus a refi?
I haven't seen any.
No, the rates aren't going to fluctuate. This is LTV driven, credit score driven.
Okay, so I love that out there. So I learned something new. Acquisition available, and normally I look at this and what I've heard from so many of the lenders and I won't say brokers. I want to talk about brokerage in a minute also. Is that there are some lenders that have no seasoning. Some have a 3-month seasoning. Some have a 6-month or a 9-month or a 12-month. Does seasoning, so the longer you own that property, does that also play into the equation of interest rate or debt service coverage or anything of that nature?
It's going to play into in regards to your LTV and going off of appraised value versus acquisition cost plus plus the what do you call it, the improvements.
Right.
So there's lenders out there that don't have seasoning,
right,
on rehab loans to where you can go off appraised value. Some of them require 6 months. It just depends on the lender.
Okay.
Yeah.
But again, you guys had, how many was that you said? 240, 270?
Yeah.
You got a boatload.
We keep adding to them every day. Anytime we can add
lenders.
an investor and give an option, we do it.
And are these, that's a bunch of lenders,
Yeah, it is.
you know, that
I love it.
are doing this business. Are these
Investors. These are the investors. These are the end investors. So these are who I'm turning to when I'm finding a client who wants to buy a house.
there are
Right.
270 DSCR mortgage lenders? in the
Not
country?
DSCR lenders, but investors. But that's 270 different investors that cover all the different loans, whether they're residential, cash outs, all different type of particular situations.
So I'm the investor. I'm at a 70% loan to value today.
Mm-hmm.
I've got decent credit. You know what makes me bad about credit? You know, I pay all my bills on time. I have no debt. I don't have, except for my homestead, which is almost paid off. You know, I borrowed them some $1 billion from my banks, but my banks continue to go out and pull credit once a year.
Mm-hmm.
And I should have an 850 damn credit score. And I think I got like a 740. It's like,
Right.
why? I know it just is what it is. I'm complaining, by the way.
Right.
That will never change. The banks, that's just what they're going to do out there. So I want to go out and borrow 80% because I've got a decent credit score.
Yeah.
I've got a good property. Loan to value's there. Debt coverage is there. I can do a 10% cash out in that scenario. If I owe 70, I want to borrow 80.
Yeah, you can go up to 80% loan to value in Texas.
Okay. So we are limited to that 80% threshold on a cash out.
Yes.
Does a DSCR loan become a home? Well, that's for, never mind. That's a goofy question to ask. That's consumer only. I was going to ask home equity. So forget that. Won't even worry about it. So I'm hearing acquisition.
Mm-hmm.
I'm hearing refi. I heard up to 85. Okay, you're pushing your numbers a little bit, so don't do that. Sweet spot 80.
Mm-hmm.
There's a low threshold where it just doesn't matter how low it is.
Right.
Got it. 30-year amortized pretty much across the board. And I'm going to ask this really subjective question because everything changes, almost changes daily, you know, on rates. So here we are doing this today, you know, in November of 2024. I know we just went through a three-quarter interest rate drop over the last 90 days or so. And there's going to be another one probably coming up. When's the next fund meeting? Probably in January.
Yeah, they're looking at 100 basis points next year. And so as far as where the interest rates are today, a lot of people have heard, hey, the Fed cut interest rates. That's great. But just as if you were going to have a party, you would send out an RSVP, right, to get a gauge of what's going to show up at your party. And it's just, that's what the market did when all of a sudden the news was the Fed's going to be cutting. So the market responded to that already. So we went to like 8% interest rates because, you know, the market got into the 8s.
Yeah. On
just regular loans that used to be at 2.25%, right? And so we went from the 8s down to the low 6s, even in the 5s. And then when the Fed came out and adjusted, rates actually bounced up a little bit, and that's typical. It usually happens, and then it usually comes down a couple, 3 weeks after that. But then we had the election as well, and so that, you know, was another moving component. So the rates bounced up a little bit. We're anticipating, all arrows are pointing that we're going to have some rate reductions coming up in the very near future.
And you think that's going to even lower rates a little bit more on the mortgage side?
Yeah, the key is, you know, the key to look at is going to be inflation and jobs numbers, right? That's a big indicator. Armando, would you?
Yeah, I
weigh
would
in
agree.
on that as well?
I would agree with you on that.
Yeah.
So you're talking to the investor marketplace out here, guys. And the key is finger on the pulse of the economy a little bit. Credit score makes a difference. Loan to value makes a difference. Debt coverage makes a difference. By the way, reasonable debt coverage.
Yeah.
You have to be able to verify and validate it. Don't tell me the rent's $3,000 a month when it's really $2,200 a month.
Right.
You got to be able to validate it, and the appraiser's going to
Sure.
do those things. I got that too. And you marry these things together, but also it's realizing sometimes these rates fluctuate. I don't want to say daily.
Yeah.
I've seen that before.
Sure.
But it's not going to be these huge leaps and bounds. So sitting here we are today, if you've got an investor out there who has a reasonable credit score, 680. By the way, not calling you on the carpet and give me an exact number. I'm just trying to get a ballpark range here a little bit. So a 680 credit score, not a 640, not a 580, but not a 740 or whatever, a middle of the road. You got a 75% loan to value. And let's assume that the debt coverage ratio is about 1.2. So you got good income coming in. So there's actually a little bit of positive cash flow that can come in. About where is that interest rate? Is it 7, 7.25, 6.75, 8? I mean,
I would,
plus or minus.
If I'm talking to you on the telephone, I'm throwing out, you're probably going to be in the 8s.
Yeah, I would agree with that.
Right now?
Yeah.
Okay.
Because of the 680. As soon as
Well,
you heard
credit
680.
score is really
Well, as soon
driving-
as he heard 680, as soon as I hear 680, so there's a threshold, right?
Okay,
680
okay.
is really the tipping point. And especially if you're going residential, just normal conventional financing for primary residences, if a score is below 680, then you're really at a fork in the road. So we're going to go this direction.
So the average FICO for these loans is in the 700s.
Yeah.
It's not your 680, 660 borrower. They're out there, but your average borrower that's taking advantage of these, it's in the 700s.
Yeah, and that's going to bring that.
And the rate gets,
down.
so everything sweetens out.
That's cool because it's understanding what affects it, as you're making the decisions. And again, investors who are trying to borrow money, they just want to borrow the money. Yeah, rate's important, but sometimes it's not that important. It's the availability of the asset that goes along the way. So I got it. So time frame. So it's December the 1st. I submit a loan to you. I want to borrow money on XYZ property. What's the usual time frame from start to finish?
I would say about 30 days. A lot of times it can happen a lot faster than that. You get some different moving components, that could raise their head. So I say 30 days. Armando, what would you? 45 days and sometimes.
Yeah, definitely 30 days, but less than that.
Yeah.
2.5 weeks.
Because you get into traditional mortgage lending sometimes, it could be 30 to 45 days. There's a lot more processing that goes into the equation on behalf of the borrower. Yeah, the same appraisal. And I get that part too. And sometimes these investors are trying to move pretty quickly along the way. But again, it's also based upon how responsive the investor is about getting information to you guys, access to the property so the appraiser can get in there. And sometimes these appraisers get busy. That can slow things down. Hopefully title's easy. But I'm hearing don't expect to anticipate 7 to 10 days. But 3 weeks, 4 weeks.
Average.
3 or 4 weeks.
But here's the deal. So with the 270 different investors that you have, right? I know that if you're coming to me and you're like, hey, we've got this deal that we need to close on super fast, right? And then I'm knowing who I'm taking who's the investor is
compartmentalized.
So, on primary residences, we're closing loans in 7 to 14 days when everybody else is taking 30 or 45 days.
No.
Well, superfastclosings.com is another URL that we own, right? And so here's the thing: when you're dealing with investors,
people don't move that fast.
Well, yeah, in my world they do.
Rarely you can get title in that quick.
Yeah.
Gosh.
Well, and it's all about alliances, right? And that's why when Armando, I know that I need something to happen, he makes it happen. So, I want to also touch on something that you said as far as your credit score. I mean, you got all these arrows that are pointing that your credit score should be in excess of 800. Right? Why is it only 740? Well, you know what? I'll look at that credit report and I'll tell you exactly why it is. And I pretty much already have an idea of what it is.
Oh, yeah.
You're probably charging on your credit card, right? You pay it off at the end of the month.
Yep, I know.
But before you pay it off is when they're reporting that information to the credit bureaus.
Yep.
And so it looks like you're carrying a balance when in actuality you're not. Right.
I know how unfortunately, I do know how the credit world works.
Yeah.
And they want you to carry credit balances. They want you to make,
and they want that score to be lower too, because they're going to make more money over the period.
Absolutely.
And so that was my driving point is when I'm looking at that credit score, and let's say you are a 680 credit score, and I'm saying, hey, because of the 680, it's causing you to have a higher interest rate than if you were at 720. So I'll look and I'll say, hey, Scott, go ahead and pay off this Capital One, do this, and then I'll rapid rescore. And my simulator tells me his score should go to 747. That is a huge difference between a 680 pricing and a 740 pricing.
My problem, for me personally, I don't carry debt.
Yeah.
Except on my real estate that we own. I try to pay cash everything. When I say cash, I pay cash, not credit card, if I can.
Nice.
And just pay the debt off. That's just my philosophy. But I know in the real world out there, most people have debt and whatnot. But being able to help the investor with little things like that too, that can push them from this threshold to this threshold, is so important also to work with them individually along the way. So volume-wise, and I'm assuming, guys, this is across the country you can do deals, not just in Texas. Right. So you're nationally. That's good. So you can help the investor navigate these things. You can help them push it through quickly. You can take a moment and help them understand how they can do some things to maybe benefit them from a credit score perspective, give them the option to do that if they have the ability to do it. Volume-wise, are you guys limited on volume, or is it unlimited volume?
Again, investors have different thresholds. Some investors say we won't do more than 10. Some say we won't do more than 20. Some investors say it's unlimited.
Well, the good thing about the DSCR investors is that they don't really care how many properties you have in aggregate. You can have 20, 30. You can have a large stable of investment properties. But like you said, some investors will require that they won't do more than 10 or 15 per ownership. So
if I ran into that wall, right, and Armando's like, we don't care, however many properties you want. Okay, so it goes from a no to a yes.
No, right? I get that.
Yeah.
It's like with Fannie and Freddie and whatnot. There's a lot in the you go traditional mortgage world. It used to be max 10, right?
Yeah.
It really was 4.
Yeah.
They tell you 10.
Underwriters.
You see a lot of borrowers come across as a DSCR loan because of that, because they're at that 10 threshold already, and they want to buy 2 or 3 more, and they can't go conventional. So DSCR is a natural progression for them in regards to financing.
So is a DSCR loan, is it going to be a little bit higher interest rate than a traditional mortgage rate?
Absolutely.
Okay.
Yeah.
So even if I'm going to go conventionally and borrow money as an investor in the mortgage world and I might be able to get a 6.5% rate.
Right.
That same rate in the DSCR world is going to be 7.5.
Always the rule of thumb, because I always say the only surprises I like are good surprises. Right. So I always say you can pretty much count about 2%. It's a good rule of thumb. So if you're at a 6%, a 6.5% environment, and you're going to the DSCR, you're going to be right around 8.5%.
Okay. So it's going to be relative in that regard, which I understand that as well. In one way, it involves a lot more processing and analysis and information versus limited over here. So there's a give and take on both sides of the equation. No, again, guys, I don't know who came up with the DSCR loan, but it's awesome for the investor marketplace. And I get what's going on. And it is so needed out there. And everybody and their mother, brother, dog, cat, whatever, wants to be a broker in the world. I see all these hard money lenders, they're now DSCR brokers. I see everybody else out there, same thing. And I know that you aren't the direct lender, but you're still the broker. But the key is having access, not to 3, 5, 10, 20, hundreds of lenders can do this. So you can shop the right lender, right time, right place, right situation, navigate these things for them. So you got the staff that you can do high volume internally also.
Right.
And get things knocked out the door quickly for the investor out there.
You bring up something into my head. I'm just thinking of it. So I like analogies. And if you think about this, the law is the law, right? It's written. All right. And
I can't break it.
When you have an attorney who is interpreting that law and defending you may have the public defender, nothing against public defenders, but if you're going up against a case, do you want a public defender or do you want the hot shot attorney that is proven, right? And it's the same way in the lending world. When you're working with a loan officer, if he's taken his business or she's taken that business to these little group of investors and they may say, no, we won't do that, right? I need to know that, yes, it can be done. It's just that the resource over here is limited. Mm-hmm. So then I know that I've got an open highway here with Armando. I know that pretty much anything that I'm going to throw at him, he's got an answer for it of a yes, we can place it. And just like a real estate agent counts on me to find the answer, I count on Armando to find the answer so that I'm helping the real estate agent's helping the client's counting on the real estate agent's counting on me, I'm counting on Armando. And we pull it all together and we close the deal.
It sounds like it rolls downhill to Armando.
It does. Good old Armando here.
Yeah, this is a total relationship business. You know, and to what Ross said is that it behooves me to make sure that we're giving him fast answers, yay or nay up front.
It definitely does
because it's a total relationship. I'm doing a good job for him. He's doing a good job for you, and everybody's happy. So.
Yeah, I mean, and I laugh about that and say, yeah, it does behoove you because at the end of the day, he's counting on me to get him a quick answer, right? And then your client is counting on you. So you're right. You're absolutely right. It really does emanate from Armando and flows up. One thing I wanted to also bring up is the DSCR as far as the acquisition. So you look and you see where interest rates are right now, and you saw where they were, right? And you saw where I'm talking about just a year ago and where they were almost 3 years ago, from a 2.25 to the 8 interest environment. So you've got buyers who are dead set on waiting until interest rates come down to around 5%, right? And they keep hearing the Fed's going to cut. So you got a lot of dads that are telling their daughters, well, wait, because interest rates are going to cut. And so what has that done is that's turned us from a seller's market where people were standing in line saying, I'll pay you $10,000 more than what you're asking for the house. Just pick me. Well, that tables have completely turned on that. And so now we're in a buyer's market. So Scott, what we're seeing is an influx of investors that are snapping these opportunities up. Because I'm broadcasting, now is the time to buy a house. If you're wanting to buy a house, now is the time to buy the house. Where the sellers are saying, hey, yes, please, we'll take your contract. And not only that, we're going to reduce the price and we're going to pay all your closing costs, right? And they're still thirsty. And there's still properties that are sitting on the market, right?
Yeah, and so investors see that. The other day, right? Agreed to pay $8,000 in closing costs for the buyer. Now, we did push the price up a little bit from our asking price to cover some of that. We're still paying some of it, and this deal, it worked. And to me, time is money.
And the appraisal the appraisal value has to go in there for you to push that price up.
Absolutely,
so it is that you're discounting the price. And the point on that is that investors are coming and they're saying, hey, we want to snap up these properties when they're on sale, right? But I've got my tax returns. My accountant showed that I had a $100,000 loss last year, right? Well, when I go to my underwriter and they're like, what are you talking about? He had a $100,000 loss, right? Because
you're not getting the conventional loan.
It's the little box that they're underwriting into. When I can move this over to Armando, and he looks at it and says, we can do this, no doc. And now real estate investor or real estate agents who are on the front lines and they're seeing these properties, they love this product. They're snapping it up because they see the property. They're able to do a DSCR loan, add that to their portfolio. The cash out. Give you an example. I had this guy who was a dentist, and when he bought his house, he wasn't self-employed, right? And so after he bought his house, now he's self-employed, and so he bought his house and he had a 2.5% interest rate. So if he wants to cash out, right,
it's going up.
He's losing that 2.25% interest rate. So we've got a product now that's a second lien DSCR.
Second lien DSCR cash out.
And guess who told me about it?
Yeah.
No kidding.
Isn't that amazing? So they keep their conventional, right? They got a 2.25% interest or whatever it is, 3.5, 5, 4, 5, whatever it is. They don't have to refinance out of that. So they're keeping the interest rate on their investment property, on their homestead, right? So they're keeping the interest rate, they're keeping that loan intact, but they're saying, hey, I want to access some of my equity. DSCR second lien is an option for them to be able to do that.
I'm assuming it's going to be, again, a little bit higher interest rate because it's a second lien, those kind of things. But when you look at that first lien at that great rate versus the second and you meld them together, is that going to be a whole
Blended
lot
rate.
less
Oh,
than
yeah.
what a new loan would be on that property?
Oh, yeah.
Absolutely,
Yeah,
it's going to be.
The blended rate's definitely.
I
I
had
think
no
that
idea.
I'm glad you brought that up. Second lien DSCRs is going to be the next big thing for your investor groups, because you have your investors that have a portfolio of properties and they have good interest rates. They can still tap into the equity and use that money to buy new properties.
So I'm going to throw this out there. So if I bought a home subject to the existing debt, where I'm actually the deed record owner, there is a first lien mortgage, 3% interest rate, not my mortgage though. I'm paying it, but not my mortgage. I can still do a second lien through a DSCR loan
on an investment property.
on an investment property.
Correct.
Cool.
Yeah.
I
You
like
know,
that.
I always tell people when you're talking to your loan officer and you say, "Hey, John, can you do this? I got this situation. Can you do that?" You are literally asking him, "Can you do this?" Right? And that loan officer is as limited or unlimited as they want to be. And if they decided that we're only going to work with these few lenders or investors, then the door has shrunk, right? But when I say, "Hey, look, I've got these over 270 different investors," now my door has come wide open. So whatever the situation is, we'll have a conversation about it. And then I'm going to direct it to one of the investors that I know is going to give highest and best value. And so whether it's you want to pull cash out of your investment properties, we see a ton of that. People are doing DSCR cash outs like crazy. And why are they doing it? Because they're buying more properties. And they're using a DSCR loan to buy the property. So they're doing a DSCR loan
using
to cash
a
out.
DSCR cash out to buy a DSCR
To buy a DSCR purchase, and they're snapping it up. It's an investor loan, and investors are snapping these properties up. That I'm on the radio letting people know, hey, you know what? If you want to buy a home right now, now is the time to do it, in my opinion, because sellers are thirsty and they're willing to do all these concessions. So that, just with you knowing that sellers are thirsty, well, now you know investors are coming out of the woodwork, right? And that's where this loan is just really proving well for them.
No, that is awesome, guys. You know, this is what is needed in the investor marketplace. It's a vehicle and a tool. It's out there. So, guys, if you're needing a purchase mortgage for an investment property, DSCR might be an option. You're needing a refinance, here's your option. You're needing a second lien if you bought a home even subject to the existing debt. Oh my gosh, it's available. If the right loan to values are there and those kind of items, that might be the tough part, but it's out there. So don't forget to take a moment, guys, and reach out to Nexa Mortgage. They're headquartered here in the DFW area. And what's that tagline again?
It's nobodybeatsmyrates.com, and my branch is here in Dallas. We're actually headquartered in Arizona. But my branch is here in Dallas.
That's awesome.
And we are here local. And
we're out in the Arizona marketplace too.
214 Ross, nobodybeatsmyrates.com.
Thanks, guys. Thanks so much. And guys, hope you liked the video there. Hope it was very value added. If you like it, take a minute and like us. Don't forget to subscribe to our YouTube channel and make any comments below. We'll do our very best to get back to you. We'll see you guys next time.
Hey, thanks.
Thank you.